The US economy just posted one of the weakest job growth numbers in nearly 4 years. In August, the non-farm payroll report showed only 22,000 jobs created. The US has shifted from one of the hottest job markets in 2021 and 2022 to now barely adding jobs at all. This slowdown pushes the labor market closer to a tipping point, where jobs growth could actually turn negative, and history shows that's often a breaking point for the economy. Going back to the 1980s, when payrolls fell below zero, a recession often soon followed, like here in 2020, 2008, 2001, and 1990. But today, despite these slow job numbers, Wall Street doesn't seem worried. The stock market keeps climbing to record highs, and corporate profits still look strong. To many investors, that signals the economy is still resilient. So, does the stock market know something we don't? To really understand this disconnect, we need to look beneath the headline non-farm payroll numbers. These job figures are being revised down at a record pace, and in 2025, those revisions have erased over 460,000 jobs from the initial reports. The May jobs figure was cut by 125,000, and for June, the initial gain was reduced by 160,000. These revisions means fewer people are being hired than first reported, and it also means the labor market may be softer than initially expected, pointing to a slowing economy. If we zoom out, we can see that downward revisions like this are outliers. In fact, the two previous times we had such big revisions in employment was during COVID and prior to the 2008 recession. If we look at 2008, we can see that payroll numbers were revised down month after month. The unemployment rate doubled from 5% to 10% in just 18 months, and the result was one of the deepest economic downturns in decades, with stocks crashing more than 50%. Today, unemployment is still just 4.3%, and while it has risen from its lows in 2023, it remains well within historical norms. But with job growth slowing so sharply, the risk is that businesses may not hire enough to absorb new workers. Over time, that pressure could push the unemployment rate higher. So why is the stock market so confident in hitting all-time highs? Well, a big part of the reason is the Fed. The Fed can decide whether to raise or cut rates. Lower rates reduce borrowing costs for businesses, which encourages investment and spending to keep the economy going. The weak August non-farm payroll report, showing just 22,000 jobs added, has markets hoping the Fed will step in sooner rather than later. And in September, that's exactly what happened. The Fed delivered its first 25 basis point cut after holding rates steady for 7 months. Big banks like Wells Fargo now even expect the Fed to follow this with as many as 5 cuts through mid-2026. But history tells us rate cuts don't always work out the same way. Their success depends on timing. And for that, we need to look at one of the most closely watched leading indicators for unemployment: initial jobless claims. Job growth tells us how many positions are being added, but jobless claims reveal when people are actually being let go, and that's often what triggers downturns. And when we overlay Fed policy, analysts see two potential scenarios. The first scenario is that we could see something similar to 2007. Back then, the Fed didn't cut rates until jobless claims were already surging, signaling widespread layoffs. By then, it was too late. The economy slid into a deep recession and stocks crashed over 50%. The same happened in 2000. Rate cuts came only after the damage had begun, and they weren't enough to stop a market downturn. However, the opposite outcome is also possible. Take 1998, for example. Jobless claims were still low when the Fed stepped in with rate cuts. That move fueled a 50% stock market rally in just months, steering the economy clear of a recession. We also saw something similar in 2019. The Fed began cutting rates while jobless claims were still near historic lows, and stocks climbed 18% in the months that followed. Right now, jobless claims have been rising higher and are at their highest level in 4 years, but they're still hovering near their lowest levels since the early 1990s, even as job growth slows. So for now, markets might be pricing in that these cuts will play out more like the second scenario. But the labor market is only one part of the equation. To get the full picture and assess the timing of the Fed's decision, we also need to look at inflation. Before the 2008 and 2001 recessions, it wasn't just that the labor market was weakening. Inflation was also climbing toward 4%, fueled in part by rising oil prices. In contrast, during 1998 and 2019, inflation stayed muted below 2% and oil prices were relatively low. That gave the Fed more room to ease policy and the economy avoided a downturn. Right now, inflation has cooled from 9% in 2022 to 2.9%, and oil prices have been trending lower. With the Fed already cutting rates before any sharp spike in jobless claims and inflation still relatively subdued, the economy could, in theory, hold steady. But risks remain. If inflation picks back up, driven by tariffs or even a jump in oil prices, the Fed could be forced to turn more hawkish, and that policy shift could become the very catalyst that tips the economy into recession. At Capital.com, we'll continue to track the jobs market and the other key indicators shaping the economy and markets and keep you updated. Hit like and subscribe to stay tuned. Thanks for watching.